Okay. Welcome, everyone. Nice to see you all here. We have a lot of people in the room. We have a lot of people on Zoom. So thank you for attending. Really appreciate it. I am Kelly Slott, the owner and CEO of California Wealth Advisors. So happy to have you all here. Those of you that don't know me, I'm going to talk a little bit about what we do and how we do it. We do have Sean Parvin, one of my very dear friends, here tonight to talk about his particular product. So tonight is somewhat product specific. Pretty much product specific. Sometimes I do these that are educational. So we do have this one coming up. This is Building Foundations for Financial Wealth, my series that I do. This one's on keys to a successful retirement, how to have a successful retirement. So that will be October 23rd. So sign up for that one. That is going to be Zoom only. Before that, we have Damian Gallagher coming from Blue Rock. That's on October 9th. So that is in person and Zoom. For anybody in here that wants to come to that one, you can come to that one too. So lots of seminars and things that we're having. Those of you in the room and those of you on Zoom that are clients, we do have our California Wealth Advisors flag. Don't forget that we have this because I can give this to you while you're traveling and you take a picture of it, and we have on our website the people that have taken it. I've had Switzerland, Germany, where else have we had? Lots of different places across the world that we've had clients take the flag. So by all means, that's here. Don't forget we have that when you travel. So, okay, let's get into the slides. Before I introduce Sean, we're going to go through a few slides. I'm going to draw some things, go back to some slides, and then we'll have Sean start talking. So go ahead, Brian. Oh, thank you, Brian and Carter. I want to thank you. Thank you, them. Let's thank you for them for being here. They're the ones that set up the meeting and everything. So those of you that have questions while we're going along here, if you can save them for the end or type them in, Carter's monitoring that so he can write down the questions. If we don't get to your questions, I feel like we maybe answered it or we'll get back to you later. Those of you in the room, we have the cards on the desks here, these cards here. Oh, I got to click. Oh, it's on me to not have the right slides. All right, sorry about that, Brian. All right, we have these cards here to write questions on. So hand those to either me or Brian during the seminar here, and we'll answer those for you when we get to the end. Okay, again, we have Sean Parvin. I will introduce him in a minute. Oops, wrong way. Okay, again, I am Kelly Slott. I do have a radio show that many of you found me on the radio show, KNX 1070. It plays on Saturday mornings from 7 to 8. All of my shows are on my website. So if you want to listen to previous radio shows, and a lot of great information on all of those, go to my website, californiawealthadvisors.com. The top one on that list is the most recent show. So you don't have to listen Saturday mornings. You can go to the website and just listen to the top one. That will be the most recent show. So I know a lot of you found me on the radio show, and thank you. And I love KNX. It's a great radio station. I did write a book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. I wrote that because I want people to have successful retirements, and I want them to avoid any blunders that I see that people do. So what's one of the blunders? Well, who are you listening to? Are you listening to your best friend's sister? And does she really know about your portfolio? Is she qualified to talk to you about your investments? I have so many people come to me and they go, well, my best friend just made $1 million in Bitcoin. And it's like, well, okay, is that appropriate for you? And there's a lot of risk to that. So be careful who you're listening to. I think that's important. So make sure you read the other blunders there. Really good. Okay. How I look at investments is really two things that are the main things to looking at investments. One is to have a plan, and have a plan that's specific to you. That's not portfolio A, B, or C. That's actually a portfolio designed specifically for you. So if you're looking for income, if you're looking for growth, if you're looking for tax advantages, make sure your portfolio is designed for you. Many people come to me and they have $1 million, $10 million in their 401ks, their pensions, their IRAs, their trust accounts. And it's great they have assets, but there's no plan for any of that. There's no strategy, nor do they have diversification, which is the second component here to investing in my view. So having diversification is key as well. So how I do that is through my master proprietary process. I know those of you on the radio that listen to me on the radio know I talk about that all the time. So this is the master proprietary process. I did do a video on this. It's on my website. So go to California Wealth Advisors under educational resources and scroll down there until you see the master proprietary process video. So this is how I create diversification for people. And this is different for everyone. So M is the market, A is alternatives, S is safe money. So M being the market, stocks, bonds, and mutual funds. Sure, a lot of people in their 401ks, that's all they have is stocks, bonds, and mutual funds. And people come to me because when they retire, they don't want that much risk. It's read for a reason. because it's going to go up and down. I don't really know what you're going to get out of it. If you bring me, or if you have $1 million, let's take an example, $1 million in your 401k, and you're going to retire next month, and you're basing income on $1 million, let's say it's 6%, so you're going to take $60,000 out of that account. That's what you need to live on with maybe all your other assets with Social Security or rental properties, but you need $60,000 out of that account. And then the market goes down and you retire, and now that $1 million is only worth $500,000. Well, now we can only create income on $500,000, not $1 million. So let's make sure that before you retire, usually right before you retire, a year or two before you retire, we start moving some assets into more conservative investments so that money is there for you if and when you need it. So M is the market, stock funds and mutual funds. I like the stock market. Lots of high income conservative types of stocks that I use for people. It is liquid, but it is red for a reason because it's going to go up and down. A is alternatives. That's what Sean's going to talk about tonight. We have a number of investment portfolios. He'll go over some of the old programs that they have and the new programs that they have as well. So I like that because it doesn't go up and down. If you invest $100,000 and it's on your statement, excuse me, it's going to stay at $100,000. I need some water. Sorry. You can grab me a water. I'm losing my voice. I have just started talking and I'm losing my voice. That's not right. Thank you, Carter. I appreciate it. Whoop. Okay, I'm making a mess everywhere. Okay. So I love the alternative space. Real estate is great. Again, Sean will talk about that. Private placements, actually, Sean will talk about a little bit of that too. And then oil and gas programs. If you need write-offs, if you want tax-free income, I have oil and gas programs as well. So again, alternative to the stock market. Good thing about it is it's alternative to the market. It's not going up and down in value every day. Bad thing is it's not liquid. You have to leave it in there for 2, 5, 7 years or however long the cycle goes, because that's where you're going to make your profit. So A is alternatives. I love that section. Great for part, not all, part of your portfolio. S is safe money. So that's when you tell me, hey, Kelly, I don't want to lose any money. I want it safe and I want it insured. I can go there. Annuities, life insurance, long-term care, insurance products backed by insurance companies. So that's a great place to have some of your money as well. Now you give up some of the profit that you could make in some of the other areas with the security you get with that. So again, some money there is great. If you're looking for income guaranteed for your life, that's the only place I can go. I can't go to the A part or the M part to create income guaranteed for your life. That has to be an insured type of product, again, backed by insurance companies. So again, I love the mass proprietary process. It works really well for most folks. And if that's not what you have, I would say give us a call and get it on the calendar with us, and we'll walk you through maybe what we might recommend for your particular portfolio. Okay, the private client process, I like to talk about this too, and here's a diagram of it, but I'm going to have Carter, maybe I can pull this over. Maybe I don't need Carter. Okay, then if we can go to the full slides. There we go. Okay, perfect. Okay, so the private client process is so unique, I think, that I created a number of years ago to really help my probably higher net worth clients manage all of their assets. So I start here. I position myself, for instance, as your financial director. So your financial director, and you have your entire financial house. So this is everything here. This is everything that you have. So here's your investment dollars over here. And I'll get back to this in a minute. But part of your financial house is you have risk. So you have some risk in your financial dollars, depending on how they're invested. But I also talk about taxes. What kind of taxes do you pay? Are you paying a lot of taxes? I know Orwin here hates paying taxes. So if you're paying too much in taxes, it's illegal. Well, I don't know if it's illegal. But a lot of people pay too much in taxes. And when you have your CPA telling you every quarter, you got to write a big check to the government because of your income or your business that you own, maybe there's ways around that. Maybe there's some ways we can help you save on those taxes. So I've never had a check, Orwin, that I've written to the federal government that they've given me back. Nope, no, that doesn't happen. Okay, so taxes is important. Are you paying too much in taxes? I think that's a big risk for your portfolio, because if you're paying too much in taxes, that's money out of your pocket that you don't have for your beneficiaries for you to use to create income. So let's make sure if there's any kind of taxes we can help you with to lower the risk of paying those taxes. That's important. Then we look at your insurances. Your property and casualty, your life insurance, your car insurance even. We look at all your insurances to make sure you have it correct. Maybe you need an umbrella policy. to cover all of your assets. Those are important policies to have. We're also going to look at Social Security. When's a good time to take it? You could be taking risks if you're taking it at the wrong time, if you're taking it too early or maybe even too late. So let's look at Social Security. So we have a lot of other things here that are risks, but there are risks to your portfolio. Let's make sure we're avoiding the risks that we see. Then we see your estate planning documents. I am not an estate planning attorney, but as many of you know, I did a seminar in 4 or 5 months ago, maybe, with my estate planning attorney and my tax CPA. It was fabulous. So I use an estate planning attorney to come up with those documents if you don't have them. So if you don't have them, or if your estate planning documents were written 10, 20, 30 years ago, you probably need to update them. Divorces happen, grandchildren happen. Let's make sure your assets are going where you want them to. So your estate planning documents are important. So to have the right trust documents are important. You need to have your powers of attorney. You need to have your medical directives. Those are very important. If something should happen to you, your beneficiaries will know to come to us to get these documents because we keep them in what we call the vault. V-A-U-L-T, if I can spell that. So the vault's over there. So that's where we keep all of your important documents, your declaration pages, your estate planning documents, your trust deeds that you might have, your any kind of documents at all, your passports, a lot of times we put over here, your driver's license too. So these are great to have in the vault because, again, if your beneficiaries ever need something, maybe you're in the hospital for 6 months and you're going to get better, but you don't have the capacity to pay your bills, they can go in here and take care of all of this for you. We put a lot of your statements in here. Your bank statements go in the vault as well. So again, your beneficiaries will know where to go. If they need to pay bills for you, they know where to go. Then we have your investment dollars over here. So it doesn't matter if you have $1 million, that's a one, or $100 million. Really, if you're not taking care of all of these things, all of this doesn't really matter because you're not doing the best thing for your entire financial house. So I did record a video on this. This is on my website as well. So again, California Wealth Advisors, and go click on private client process, and that'll walk you through this in more detail. So love the private client process, works really well for a lot of folks. So just let me know if you're interested in that. Okay, I think I can move that back. All right, let's get Sean up here. Okay, so we have, not yet.
Okay. I've got too excited
to get up there. So we have Mr. Sean Parvin, one of my very dear and very close friends. He is the senior regional director, sales director for Nexpoint Securities, and they represent a number of different programs that they have out there. Sean, again, is for the Southern California region. He received a Bachelor of Arts degree from Pennsylvania State University, where
we are.
What?
We are Penn State.
We are Penn State.
Yeah.
Where he was a member of the Division I baseball team. And he's a very good golfer. I've golfed with him quite a number of times. And more importantly, he has a 13-month-old daughter named Brody that I know he's very proud of. And I want him to have another one. So let's see if we can have him do that. So with that, I will bring you up. So we'll have questions at the end, I think. So Sean, come on up.
Cool.
Thank you for being here. We really appreciate it. One of my very dear friends.
You're my favorite.
Oh, I'm his favorite.
As always. All right, sweet. Look at this. What a setup. Hey, everybody on camera. As Kelly mentioned, I am Sean Parvin. I work for Nexpoint. So figure what I'll do here today is give you guys a little bit of a background on who Nexpoint actually is, our track record history, what we've done in the real estate realm. We'll talk about some of the old programs that we've closed out that are looking for liquidity. I'll talk about my entire platform of all the different types of offerings that we have. And then lastly, we'll cover what's on your screen in front of you, which is our Series B non-traded preferred stock. That's a 9% yield. So before we get into that, Nexpoint is based out in Dallas, Texas. I actually live here in Southern California, down in San Clemente. So I just cover a specific region for our company. But we have about 15 other people that do exactly what I do across the country. We raise roughly anywhere from $1 billion to $2 billion a year as a sales force and a company. We actually just crossed $1 billion of equity raised yesterday at our company level. So pretty impressive. We're probably one of the larger companies you've never heard of before. We manage about $33 billion across our entire platform. That spans from publicly traded real estate investment trusts. We have 3 different ones on the New York Stock Exchange. We have open-end mutual funds. We have closed-end interval funds. We have 1031 DSTs, which we'll touch on. We have an annuity platform. We also have a bank in Dallas. we have quite a lot of
Is
things.
there anything you don't do?
Yeah, as Kelly mentioned earlier, I went to a state school, so imagine me having to keep all this stuff in my head every single day. It's pretty hard. But yeah, we do quite a lot of different things, but we're well diversified. We have about 150 employees that work at Nexpoint directly, most of them obviously in the home office in Dallas. So 2012 is when we were founded, but our original parent company was called Highland Capital, which is also based in Dallas. We had the same crossover CEO. Highland was all institutional only, so no retail investors, which Nexpoint spun out in 2012 to focus on the retail channel, which is why we're in this room here today. So that's kind of a history of kind of where we came from. Track record wise, since 2012, we've acquired now just north of $20 billion worth of real estate. That's been spread across really 4 core asset classes that we manage here at Nexpoint. Those would be single family home portfolios. For reference, we are the 7th largest operator of single family homes in the country currently today. Most of our assets are in the Midwest and in the Southeast up to the Carolinas. We manage 25,000 single family homes at our portfolio level today. We also do multifamily. We run a publicly traded multifamily REIT on the New York Stock Exchange, NXRT. It's got a 10-year track record. It's been one of the best performing multifamily REITs out there. Those are all Class B value add. Again, Midwest, Southeast is our geographic region. We also do self-storage. We have about a $2.2 billion self-storage platform, roughly 75,000 units across the country that we manage. If you drive up and down the freeway, you've probably heard of Extra Space Property Management, right? They manage all 75,000 of our units. And then lastly, industrial, and then segments of industrial. So we're really heavy, especially in the DST world, into what's called mixed use industrial or shallow bay or small bay industrial asset classes. We also do manufacturing in industrial, which would be in life sciences, and semiconductor manufacturing. So if you've never heard of semiconductor manufacturing, you probably have a cell phone or some sort of technology. Any sort of technology is built on a chip that is a semiconductor chip. So we own essentially the real estate where those chips are developed. Life sciences, if you've never heard of before, think of a sale leaseback. So think of like a building like a Walgreens or a CVS, but instead of having them as a tenant, you're having a biopharmaceutical company as the tenant. So that creates a very sticky type of tenant because they're investing heavily into the property, generally anywhere from 10 to 12 times more into the property than we actually bought the shell for. So all these asset classes kind of have one commonality that we strive for, which is recession resistant in nature, provides a durable and predictable type of income stream. So that's what we've really built our platform around since our inception period. And we've done, I think, a very nice job of diversifying our asset mix and delivering great returns to our shareholders. I think one of the best things personally that I love working here at Nexpoint is our commitment to our shareholders and how much money we put up alongside of our shareholders in various funds. We've invested now just north of $900 million across all of our different funds alongside of our investors. So when we do that, we're able to have a little bit more creative fee structures and no back end splits. You've probably heard of deals before where there's like an 80-20 split on the back end or 85-15. We don't really do any of that because we're the biggest investor. So we usually have a disposition fee at the end, right? If we do what we say we're going to do, we're going to get a fee at the back end, but 100% of the profits after that go to investors, right? Because what's best for us is best for you and vice versa. We've taken now 80 investments full cycle in real estate. Those have generally been in multifamily, but those have then generated just north of 20% annual returns to our investors. So did very, very well. Obviously, we're in a different real estate environment now, which is why we're going to talk about the debt side of real estate here in a minute. But wanted to pause there and kind of let everybody digest that. In terms of updates on old funds, I mentioned obviously we're very heavy into single family homes. One of the first programs that we rolled out was called Vinebrook Homes, which we actually got to partner with a company called Vinebrook. That was back in November of 2018. We started at $25 a share. We are now at about $54 and change right now today. So it's done extremely well. We are looking and hoping for an IPO. Now, IPO isn't just a flip of the switch and, hey, we want to go public and let's do it. There's a lot that goes into it, right? You have to register, obviously, the IPO. You have to get investment banks behind it. You have to do a roadshow and raise institutional capital. You have to get index support, so on and so forth. So we've done all of that. We are ready to go public. The problem is the public market isn't ready for our type of asset class. And what I mean by that is there's currently 3 true comps in the marketplace, and I'm really only going to say 2 that are actually the ones that we're looking at. So American Homes for Rent, which is AMH, and Invitation Homes, which is INVH. Those are the 2 largest single family home operators that are publicly traded in the marketplace today. I didn't check this morning, so forgive me, but a couple of weeks ago, I was pulling up, all this different type of data of, hey, what's the realistic time we can go public? Because that's what everybody wants us to do, right? We want to monetize. We have all these gains that we've made in the portfolio, but we can't touch them yet, right? We want to actually be able to have liquidity and then diversify our assets again. Well, INVH and AMH were both trading anywhere from a 20 to 30% discount to their NAV, meaning if their price is, X, they're trading at 20 or 30% lower than what the true value is. So that means if we wanted to go public today, we would probably trade with our peer group, which means we would go public and lose 20 to 30% of our value immediately on day one. Nobody in this room or on camera probably wants any of that to happen, right? So the benefit for being private right now is we don't have to deal with that volatility. We could still pay you the nice $2.12 per share annual payout. You'll still keep clipping your coupon. And then hopefully, once we see some rate relief, the Fed's already talking about September and December as two potential rate decreases. That will be very good for the macro real estate environment, right? We should see some what we call cap rate compression or asset prices rising as well. That should be very beneficial to our portfolio. Assuming we see those things here at the end of the year, I'm hoping that sometime in maybe Q2, Q3 of next year will be an opportune time for us to finally realize this investment, go IPO, and have our liquidity event for our investors. In that particular REIT, we raised $1 billion. We have $150 million of Nexpoint's own money in that deal, right? So 15% of the money is our own money. So we obviously want this thing to be very well because we would love to make a huge return and be able to go and do something else with it. So that's where we are in Vinebrook. Again, I think sometime early or mid next year is probably very realistic, assuming we get some rate relief and assuming obviously they start trading closer back to their true value of their NAV, because right now they're trading at a pretty big discount. So that's the benefit of being private, though, is you don't have to deal with that volatility. But at the end of the day, we do need the market to be in our favor for us to realize the investment, right? Unless we go out and sell it. So if Blackstone wants to come up and pay us a couple $1 billion for the portfolio and go private, like fine by us, we'd love that. But just hasn't happened yet. So all news is good there. We're just going to keep clipping the coupon, keep trying to grow the value while we're private. Okay. All right. So to the main event here, we are. Oh no, wrong one. I went to estate school, like I told you guys. Okay. All right. What are we doing here? Cool. Okay. So today, I mentioned earlier, we run 3 different publicly traded REITs. We have a multifamily REIT, we have a diversified REIT. The third one is called a mortgage finance REIT, right? So everybody's probably heard of the term mortgages before, right? Probably have a mortgage on your home. We run a mortgage finance REIT, which essentially is just a non-bank lender, right? If you guys are familiar with where we are in the real estate market since 2008, banks can't lend like they used to, and probably for good reason, right? They all got bailed out, and I think one guy went to jail for it, and everybody else suffered. So here we are again. But the banks, they can't lend like they used to. So what we're able to do is, or what's happened then, is now we have about $1 trillion lending gap from different commercial real estate developers or real estate funds or real estate operators that need access to capital that they can't get through the traditional banking mechanism. So number one, you've already created this lending gap. Number two, since they're coming to us as a non-bank lender, guess what we get to do then? We get to move that interest rate up a little bit higher because they can't go anywhere else, right? Now we have to make sure they're able to pay that interest rate, but we know we're going to get a better rate than they're going to get from the bank, right? So we're going to be able to command a higher interest rate than that they'll get from a bank traditionally. So for us, as the non-bank lender, we focus on 4 core asset classes in this overall REIT, okay? So the REIT itself is on the New York Stock Exchange, NREF, Nexpoint Real Estate Finance is the ticker symbol, okay? The common stock or enterprise value is about 1.1 billion. There's about 86 total loans in the portfolio. And those are all loans backed by real estate in 4 core asset classes. And you guessed it, they're the same 4 core asset classes I already talked about. Single family home portfolios, right? So these are not individual mortgages on homes here in Santa Barbara from an individual, right? Albeit they are very nice homes. We love them. We are not waiting for an investor to pay us their mortgage to pay a dividend. Okay, we are doing these on institutional levels where an operator that owns, call it 10 to 15,000 single family homes is the one that's paying us that coupon, okay? And then we're distributing that out. We also do multifamily. The multifamily complexes that we have on the debt side are anywhere from like 200 to 400 unit counts. So these are big projects, institutional projects. We have self-storage, I already mentioned earlier, big, what we call Class A climate controlled facilities. They're all managed by Extra Space, built within the last 5 years, and then life sciences, so biopharmaceutical companies and their real estate. So those are the 4 core asset classes that make up the REIT. Now the REIT has been publicly traded since February of 2020, okay? So the REIT itself is the one that issued this non-traded preferred. So the reason why I'm talking about the REIT is because you're getting access to this REIT, right? And you need to know the underlying investments inside of it. But underneath the hood, you're not buying the common stock, which obviously, if you're familiar with a capital stack, that is the last to be paid. So how a capital stack works is you have the bondholders that get paid first, then you have the preferred holders, and then you have the common stockholders. Right? So any profits left over at the very end go to the common stock. Okay. So they're the last to be paid always. You're one up the capital stack in the preferred structure. Right. Our common stock, we've been able to grow the dividend since we've been publicly traded from 40 cents a share to now 50 cents a share, right, over the last 5 years. So we've done extremely well. We've also never had a default in the history of this portfolio. Okay. So what I can tell you is one time we almost did. And the benefit of working with a company like Nexpoint is, and because of our size and scale, is there was an asset down in Georgia that we had ranked in our risk system as a 4. Right? Once we get to a 5, it's like it's going to default, everything's going to go bad. We're going to have to go and take the asset and the equity. Because of our size and scale, especially in multifamily, we have a preferred partner called BH Management. They're one of the, I think, the 7th largest operator in the country of multifamily assets. We are their biggest client. So what we were able to do in this particular asset is we kicked out the property management team that was originally in this Georgia asset, instilled our usual property manager, got the asset back online, lowered expenses, started driving NOI, and now that 4 risk score is down to a 2, right? So we don't have to deal with that ever again. So that's the benefit of working with a company like Nexpoint is we're going to go in there if something's not going right, and we're going to fix it as much as we can. And in that particular situation, it worked out great. So again, we got saved. We never have had a default ever in this portfolio. The company's done tremendously well. It's been one of the best performing mortgage REITs in the marketplace since inception. Now, the preferred, instead of buying the common stock, you're buying the preferred, you're buying at $25 a share, and you're getting a 9% coupon, okay? The 9% is a fixed rate. It's an annualized dividend that's paid out monthly. So you in this room or you on the screen are probably sitting there and saying 9%. That seems pretty high. How are you able to actually pay that, right? Well, how does the math work? The math works as such. We are paying 9 plus the fees on top. So call it our all-in cost of capital is 10%, okay? Now, through our lending, which obviously, as I mentioned earlier, our rates are a little bit higher than what you're going to get at the bank, plus some leverage at the company level. We're about 58% levered at the whole corporate level. Through those two mechanisms, we're having a cost of capital of 10, and we're earning anywhere from 13 to 15%. So that means we're making a healthy spread of anywhere from 300 to 500 basis points, which is going to grow the old parent company, NREF, right? The $1.1 billion REIT. That's going to grow the portfolio even more and allow us to do more loans and build the portfolio out even further. Other side of the coin is you're getting a nice 9% distribution that's fully covered by its dividend, right? Or by its interest income. So the equity side, the common stock is covered by 1.08 times, which means we're covering our dividend and then some, right? A little bit more. Now the preferred, since you're up the capital stack, we're currently covering our dividend by over 300%, right? So your protection obviously is wonderful because you're in the middle of the capital stack, right? You have plenty of dividend coverage. And then secondly, you're on the debt side of real estate at the end of the day, right? So when you're on the debt side, when we talked about that capital structure, right? Who gets paid first? The debt holders, right? So us in NREF, we get paid first on any of these mortgages. So we get paid first no matter what on the mortgages. And then secondly, you're in the preferred structure, right? So you're up the capital stack and you're going to get even more protection because you're not last to be paid. So it's a wonderful place to be. And in this particular fund, we came out as a non-accredited investment. Most of these types of funds are all accredited only, where you have to have $1 million of investable net worth, so on and so forth. We made this non-accredited where it's only a $5,000 minimum. We put a $400 issue out. So that means we're raising $400 million. Your protection on the preferred, obviously outside of just the capital stack structure and being in debt, is there's $400 million of common stock. So essentially what would have to happen for your preferred ever to get hit or touched, we would have to erode all $400 million of that common stock, right? We'd essentially have to default on everything when we've never had a default. So could it happen? Sure, right? Crazier things have happened in this world. We live in a pretty wild time as it is right now, especially with the news going on. So could it? Sure. Do I think that'll happen? Probably not. I think we're pretty good at what we do. We have a very healthy debt service coverage ratio as well. We have a 1.44 debt service coverage ratio. If you're not familiar with that term, what that means is that for every dollar of debt, we're earning $1.44. Right? So we have a very healthy spread between our actual debt versus what we're earning in the entire portfolio level. Okay, so things are going tremendous. Now, the catch is, right, there's always a catch. We paid all the fees up front. Okay, so you literally are not paying any fees, but nobody does anything for a free lunch, right? So how is Nexpoint making money? Why would we be doing this for free? Well, here's how we make our money is we slapped a 4-year declining surrender schedule on this non-traded preferred. So it's a covered security. It's immediately redeemable at the end of tomorrow. If you bought in, you could get out tomorrow. But if you do that, you're going to pay a penalty based on whatever year you get out before 4 years. So on your screen, you could see that redemption term, right? Before a 1-year anniversary, there's a 12% penalty. You're clipping 9%, right? So don't do that. If you're going to hold it for 1 year and 1 day, it's a 9% penalty to redeem early. Don't do that either, right? It takes away all your income. You make nothing. 2 years and 1 day is a 6% penalty. So net, you'll still get a 6% annual return after you pay your redemption penalty, if that's something you wanted to do. 3 years and 1 day is a 3% penalty, right? So you'll still net 8% annually, even after your penalty. And obviously 4 years and 1 day, there is no penalty at that point. You could redeem whenever you please. We cannot shut off redemptions in our prospectus, per our prospectus. So if you want out, you're going to get out. There's 2 ways the game ends, right? We talked earlier about Vinebrook, how we have to wait for the market to be in our favor and have to go IPO. The benefit of doing a preferred stock is either you call your position or we call your position. And what I mean by that is you submit a redemption form, right? We have technically up to 45 days at the board of director level to give your redemption back. It's taken us 5 days usually when people have redeemed. So number 1, you can get out that way. Number 2 is we can call your position away, but only after you've held it for at least 2 calendar years. So Nexpoint's board of directors can call this position away. And in reality, the way that's going to happen is, I should say, if that happens, is if we see a drastic drop in interest rates. Okay. So if we go from wherever we are today down to almost 0, like we were for almost a decade, it's going to be more beneficial for our overall REIT and our shareholders to go get a traditional cost of capital through a bank, right? Maybe get 5 or 6% versus using the cost of capital through a preferred at 10%, right? So is that a situation that could occur down the road? Certainly could, right? You might only hold this for 2 years and then we're going to call you out. We can redeem in cash or in stock as well. So I want you to be aware of that. Now, our goal is always to pay in cash. We have plenty of cash available for distributions. We have plenty of cash available for redemptions. But I mentioned earlier, we have quite a bit of our own skin in the game. Out of the $400 million of common stock, we own $200 million of it. Okay. So that means we don't want to dilute ourselves. How does dilution happen? Is when you issue shares when you're trading at a discount to your NAV. Most mortgage REITs in general trade at a discount to their net asset value. It's just how they've historically traded, usually anywhere from 5 to 15% of a discount. So that means if our current book value today in our NREF common stock is $17.40, which is what it is as of Q2, and we're trading as a stock price at $15 and I think 33 cents is where we ended today, we're trading at a discount to our book value, right? So if you submitted your preferred redemption, we would look at the common stock and say, we're trading at a discount. We're going to give them cash, right? That doesn't dilute ourselves. Now, on the opposite side of the coin is if we are trading at a premium to our book value, let's say we're trading at $18 and the book value is $17.40, we're going to issue you shares in that point, right? Because that's not dilutive to our own position and our original common stock shareholders. That all makes sense here? Okay. Oh, look, I already did all that. How about that? Cool. Hold on. There we go. So where we are on the portfolio and why I think this is a wonderful time horizon is, again, 9% annually, paid out monthly, no volatility along the way. The benefit, obviously, is the portfolio is stabilized. You got 77.5% of our assets are stabilized. Almost 4 years of average duration. Right? You guys have probably heard of the refi doom coming. Right? All these banks have all these different loans at a much lower interest rate from years ago. Now they're going to have to refi at a much higher rate. Right? We went through the regional banking crisis. What was that, last year or the year before? So it's an interesting place to be. Thankfully, our average duration is much longer. We don't have to go through any of that type of nonsense. Obviously, direct management ownership is 12%. That is literally direct management ownership of our own cash. But if you include all of the common stocks, from all of our different affiliate funds. That makes up about 50%. So I mentioned about $200 million. The portfolio is doing extremely well. We've raised $332 million of the $400 million that was issued in this preferred stock. We're doing roughly $20 million a month in a capital raise. So that means we probably have about 3 months left before we close out this offering. And that will be the end of this offering, right? And again, at that point, you just sit back, clip your coupon. 4 years go by, you could redeem with no penalty, or you could redeem if you wanted to with a penalty. But that's how this whole game ends. It's very boring. It's very easy. It's a 9% fixed rate, right? So you don't have to worry about if rates drop tomorrow, what's going to happen to my investment. You're locked in at 9%. Again, we might call it away in 2 years, but you're locked in at 9. Okay. Then the last couple things I want to share with you is, obviously our asset mix. We've already gone through basically all the different things that we like, but a huge differentiator that we have here at Nexpoint is because of our size and scale and how much money that we trade on Wall Street each year in fixed income, which is roughly 15 billion. We get access to special deals that really no other firm, at least in our little alternative space, gets access to. They're called Freddie Mac K deals. So Freddie Mac started this program back in 2009. We were an early adopter because of our multifamily and single family home experience. Freddie Mac will basically go out and issue a pool of, call it a $500 million portfolio of multifamily or single family home portfolios, okay? We're not gonna take down all 500 million, but we'll take down a tranche of that pool of, call it $50-ish million, okay? Freddie Mac's K program, which again, we're one of 15 firms to be able to get access to, has had an annual 3 basis point default loss since 2009. It's extremely low. Now, the benefit is the ones that we've picked out of the Freddie Mac K program, nothing's ever defaulted, right? So I think we've done a very good job of mitigating risk, finding different tranches in the equity stack where we could take potentially a little bit more risk with more return, but also still having a very nice, boring 9% income that's paid out monthly. So I'd say the only negative behind this is you cannot reinvest. You have to take the cash, which is a cool thing because in 6 months, Kelly's going to direct your money to a brokerage account. She's going to call you and say, hey, remember that investment we did 6 months ago? It's paid out every single month like we said it was. We've got more money now in our brokerage. Let's go buy something else, right? Maybe a new car. I'm kidding. Probably some tax strategies right at the end of the year. That's right. That's what I was doing earlier, Orwin. Speaking of taxes, in terms of the dividend, this is the debt side of real estate. So if you're not familiar with how debt and equity works in real estate, equity side gets to participate in the pass-through depreciation. So you really shelter a lot of your income stream. The debt side of real estate does not get to participate in that pass-through depreciation. So you're going to have more taxes on this particular income versus an equity REIT. Now, the good thing is the preferred stock is off of a REIT, and our current president and administration obviously advanced the Jobs Act all over again, right, and extended it. So that means we still have the qualified business income deduction, right, which is 20%. So that means 9% or 20% of your 9%, you don't pay any tax on whatsoever. It goes out the window. See you later, right? But 80% of the 80% of the dividend is going to be taxable. It's going to come on a 1099. Okay. There's no recapture. There's no UBTI. There's none of that kind of stuff, right? It's a whopping $5,000 minimum. It's very, very boring. Okay. So again, 9% backed by real estate. You've got 3 months left to do it. It's gone after that. Make sense? Very good. Okay. Happy to take any questions, give you answers.
Okay.
You tell me.
We have questions. All right. Do you want to go to the other slide? Or well, here. Do I do? Oh, no, I don't want to. I'm sorry. Yes, that's what I wanted right there. Yeah, perfect. Okay, Sean, we have questions. Okay. When do you think the Vinebrook home will go full cycle? I think you might have answered that.
Yeah, I think, again, barring or seeing if we get rate relief September, December, and hopefully into early next year, I think Q2, Q3 makes a lot of sense next year.
Well, if they lower interest rates at all, that'll be really helpful.
Yeah, for all like macro level in general. Yeah.
Yeah. And I think you mentioned this too, but do you do 1031 exchanges?
We do. We do quite a bit of them. We've done 27 of them, taken 3 of them full cycle so far. We'll probably have anywhere from 4 to 7 go full cycle next year. And I would imagine probably the same type of number in 2027.
Okay. What's the interest rate on the preferred offering?
9.
And then are there any tax benefits? So I think you mentioned that too.
Just mentioned it. Yeah. Look at that.
You're ahead of the game, or if people aren't paying attention, who knows? Okay, so the 9%, let's just to be clear, is you can do it in retirement accounts, you
Yes.
can do it in trust accounts, you can do it in your individual name, so
Yep.
that's good. I like 9%, and then 80% is taxable, but 20% is tax advantage,
Right.
which is great. Okay, and that shows up on the 1099.
Yep.
Okay.
Nice and boring and simple. I think
Beautiful.
most of the money's been IRA money just because of the tax side of things. But obviously, if you're in the higher income tax bracket here in California and you do it in a non-qualified account like an individual or a trust, your tax equivalent yield is about, I think it's 10.52%. So a little nice because you do get some tax advantages. Obviously, you could get more through an equity, but yeah.
Okay. Any questions in the room? Oh, wait, here's one. If I can read your writing, Chris.
Why is there more taxation?
Okay, ask your question,
Of
Chris, because
REIT?
we can't read your writing.
Can I read it?
She's gonna read her own question.
Taxation on this kind of REIT.
Because it's the debt side of real estate.
Say
So-
the question again, just in case.
Why is there more taxation on our preferred stock off of our publicly traded mortgage finance REIT was the question. The reason why is because we're on the debt side of real estate, so we're feeling interest income versus the equity side of real estate, which gets to participate in what's called the pass-through depreciation, right? So being on the debt side, we don't get to participate in the pass-through depreciation, which is why we have more tax. Through depreciation, you're able to shelter most of that income tax. So like in our Vinebrook homes, for example, I think last year's dividend was 100% tax deferred. So you pay no tax on the dividend, but
Well, the difference between the Vinebrook Homes type of real estate investment trust versus the 9% preferred is you get the dividend from Vinebrook Homes, for instance, and that's 4 or 5%, I think. Is that
yeah,
what you're
just depending
saying?
on when you got in.
Depending on when you got in. So 4 or 5%, but that's, like you say, 100% tax advantage. So that's great, especially if you're in a high tax bracket. But you also get the capital appreciation on the underlying real estate.
Right.
Here you're getting a 9% yield, but you're not getting any capital appreciation because it's preferred loan, if you will.
Yep.
So it's a different investment. Which one could you make more money with? Probably something like Vinebrook Homes.
For sure.
But you're not going to get that current yield. So a lot of clients come to me because they're retiring, they want to have that higher yield, or they're already retired and they want to have that higher yield. They're not looking necessarily for growth.
Right.
So that's why it's nice that Sean has a number of programs that we can go into depending on what you need. What do you need out of it? And that goes to the tailor making I mentioned earlier about your portfolios and what you're looking for. We're going to tailor make it for you. We're not sticking you in portfolio A, B, or C, which I see a lot of the wirehouses out there do that. Okay, Sean, thank you so much.
You bet.
We appreciate it.
Thank you, Kelly.
Thank you,
Thank you, everybody.
Thank you, everybody on Zoom. Again, if we didn't get to your question or you have another question you didn't ask, by all means, send it in and we'll answer it for you. And thank you, everybody. The next one is October 9th. So make sure you sign up for that one. Okay, thank you, everybody. Appreciate it. We'll see you soon.